a surety bond, okay? Which, I mean, it sounds like pure financial jargon, doesn't it? Like, something buried deep in the fine print somewhere.
Yeah, it really does.
But here's where it gets genuinely fascinating, I think. These bonds, they're actually impacting whether new apartment buildings are getting built in your city.
Right.
It's directly affecting that housing supply we all talk about needing.
It's almost like a cosigner, right? For a huge construction project.
Exactly. A guarantee from a third party, someone financially solid, saying, look, if this builder can't finish the job,
we'll step in. Yeah. Make sure it gets done.
And suddenly this financial tool that was kind of obscure, it's now a major bottleneck.
It's pretty remarkable, isn't it? How a seemingly subtle shift, in just one financial requirement can ripple through a whole industry.
Yeah.
And touch something as fundamental as, housing availability. This isn't just abstract paperwork we're discussing.
No, not at all.
It has very real-world consequences.
Yeah.
It directly influences the pace, the certainty of new homes actually reaching the market.
And that's exactly why we're doing this deep dive today. Our mission really is to peel back the layers on these tightened bonding rules from CMHC.
Specifically within their MLI Select program.
Right, MLI Select. You might not have heard of them specifically, these rules, but trust us, they are having a significant direct impact on Canada's housing supply. We're going to try and reveal who exactly is affected, the challenges they're now facing, and what this all truly means for how quickly new homes get built and, reach people like you.
So the goal is like a shortcut, right? To get you properly informed on this critical piece of the puzzle.
Exactly. It's often overlooked, this bit of real estate development. I mean, imagine like the Ascent, but let's call it that, a planned 200-unit apartment building.
Okay.
In your neighborhood, maybe. Designed to be affordable, maybe eco-friendly, all ready to break ground. Permits are there, financing looks solid, probably through MLI Select.
Until this hit.
Until this new bonding requirement suddenly got serious, and poof, the Ascent is stalled.
Hundreds of potential homes delayed.
And that ripple effect just starts spreading. That's the kind of real-world impact we want to dissect today.
And it really does highlight these, hidden levers that influence our communities, often in ways we just don't see immediately.
Absolutely. So let's set the stage a bit more. CMHC, that's the Canada Mortgage and Housing Corporation. They have this really important program, MLI Select. And for developers building multi-unit residential buildings, it's been a key financial tool.
Designed specifically to get more housing built. That was the whole point.
Right. It rewards what they call socially responsible builds. So projects meeting certain criteria, affordability, accessibility, maybe environmental standards.
They get access to high leverage financing.
Which means?
Well, it means they can borrow a much bigger chunk of the project's total cost.
Okay.
Plus, they get longer amortization periods, more time to pay back the loan, and really low cost capital. Cheap money, essentially.
So the whole program was set up to fuel new construction, be a catalyst.
Yeah, exactly. Incentivize growth in housing supply. It really does sound like a win-win.
It does, but here's the twist, right?
Here's where the plot thickens, yeah. As of late 2024, CMHC really tightened its enforcement of this critical surety bond requirement.
Okay.
For many, many projects under this MLI Select program.
So the impact is clear, we see that, but let's dig into the why now a bit. Was CMHC seeing, a spike in stalled projects, or maybe just seeing more risk they didn't want?
That's a really crucial question. And, CMHC doesn't always lay out their exact triggers publicly.
Right.
But the general feeling in the market, the sentiment, it points towards an increased focus on de-risking their loan portfolio.
Makes sense.
Think about it, right? If projects fail, or they run way over budget, and there aren't adequate guarantees in place.
CMHC is left holding the bag.
Precisely. They're directly on the hook. So this tightening, it's essentially CMHC saying, look, we need stronger assurances. We need to know these projects will actually get built on time, on budget.
Even if things go sideways with the developer or the main contractor.
Exactly. So that access to the really good stuff, the high leverage, low cost financing, it's now contingent on this requirement.
A requirement that wasn't really a bottleneck before.
No, it wasn't enforced this strictly.
So what does that actually mean on the ground for a project like our Ascent building, maybe one that's already started or one just trying to get going?
Well, it means that without these surety bonds properly in place, that MLI Select funding can be delayed.
Okay.
Or, even worse, it could be completely withdrawn, pulled.
Wow. Okay.
And that directly stalls projects midstream. It prevents those much needed homes from ever reaching the market, or at least delays them significantly.
And for the real estate pros listening.
Oh, for them, it's not just an inconvenience. It can mean delayed closings for buyers, disrupted pre-construction sales campaigns.
Fewer new listings eventually.
Absolutely. Fewer new listings hitting the market down the line. It's a technicality, quote unquote, that genuinely impacts the entire housing pipeline, from the first idea to someone moving in.
So this ripple effect, it's not theoretical, it's stalling real projects, like our ascent. But who exactly is feeling the brunt of this? Because it sounds like it's not hitting all developers the same way.
That's a really important question, yeah. And it shows just how complex the whole supply chain is. Under this new framework, there are basically three distinct groups really feeling the pinch.
Okay, who's first?
The first group are the self-performing developers. These are the ones who manage and build their own projects. They take on all the risk themselves, soup to nuts.
Right.
For them, just securing these surety bonds can be incredibly challenging. And a big reason is that the market appetite, the willingness of bonding companies to provide these bonds, it's quite limited.
Really?
Yeah, I heard about a recent instance where only two companies, just two, were even willing to offer terms to developers like that.
Wow. That tells you something.
It tells you how specialized and, frankly, difficult this can be for them.
So it's not just about getting the bond, it's even finding someone willing to issue it, and maybe on terms that don't kill the project's finances.
Exactly. Okay, so the second group, that's developers and their general contractors. For them, the pressure isn't always about getting their own bond.
Okay.
It's more about needing to make absolutely sure that the bonds their subcontractors provide are fully compliant with CMHC's new, tougher standards.
So it adds another layer of paperwork and checking for them, due diligence.
And risk management, yeah, big time. And then there's the third group, specialty subtrades.
Like plumbers, electricians.
Exactly. HVAC, concrete formwork, you name it. What's really unique about them is that many have simply never been asked for bonds before.
Never.
Especially not for apartment projects funded under MLI Select. It just wasn't the standard practice. And now, suddenly they must get them.
Which is a completely new requirement for them, often totally unfamiliar. That's a huge shift. So just to be clear, previously, CMHC didn't really enforce bonding on projects it backed.
Not merely to this extent, no.
And now it's mandatory. A required level of financial guarantee for specific builds, usually over 25 units, you said.
Typically, yeah. But CMHC also has the discretion to require it on smaller projects, too.
Okay. So it really sounds like for all three groups, self-performers, developers managing subs, and the subs themselves, this whole bonding process is largely uncharted territory.
Mm-hmm.
They need a crash course in the surety market, what the industry expects.
It fundamentally challenges practices that have been established for years, sometimes decades.
Yeah.
I mean, picture master plumber, right? Best in the city, 30 years experience, suddenly being asked for a complex financial guarantee he's never needed before to work on a specific type of job.
It's like asking him to get a pilot's license to drive his truck.
Kind of. It's a completely different regulatory hurdle, one they're just not equipped to handle without getting up to speed fast.
Yeah.
It's a total paradigm shift in how they have to approach bidding on these projects.
So it's definitely more than just, filling out an application for a bond, isn't it?
Oh, much more.
Sounds like there's some pretty significant structural barriers.
Oh, yeah.
Especially for those newer project entities you mentioned, the ones set up just for one big development.
The details here really matter. A surety bond, what it boils down to is it acts as a kind of third-party validation.
Okay.
It's a signal, right? That the party being bonded, whether it's the developer, the GC, or a subtrade, has the financial strength.
The money.
The financial capacity, yeah.
Yeah.
Plus the necessary experience and the internal system of the organization to actually complete the work they promised.
Got it.
But here's the common challenge. Developers often set up a brand new corporation for each individual project. A single-purpose entity.
Right, I've heard of that. For liability reasons, usually.
Exactly. But this new company, this entity, often has very limited assets of its own and zero operating history.
So, to a bonding company looking at risk,
It looks like a ghost, financially speaking. It's a huge hurdle for surety providers trying to assess the risk involved.
okay, that makes perfect sense now. So how on earth did they get around that then?
Well, often, to meet the surety provider's requirements in those situations, the only realistic way forward might be to secure collateral mortgages on other properties the developer owns.
So using the value of other real estate as security.
Precisely. Or They might need to provide substantial additional guarantees, either personal guarantees for the principals or corporate guarantees from the parent company.
So it ties the new project's success back to the broader financial health of the developer group.
Essentially, yes. It links it back to established assets in history rather than just relying on the new empty project shell.
Okay. And what about those developers who are hiring the contractors? What specific details do they need to be laser focused on now?
For them, it involves first a really meticulous review of the bond wordings.
The actual legal language.
Exactly. The fine print that defines what's covered, under what conditions the bond pays out. It's crucial. They also need to confirm that their chosen contractor is genuinely eligible for the required bonding.
How do they do that?
Well, they need a thorough understanding of the pre-qualification process. And here's a really key detail. A pre-qualification letter needs to come directly from the bonding company itself.
Not just from the insurance broker.
Right. A letter on a broker's letterhead alone. That might not cut it for CMHC.
Ouch.
Imagine getting a letter that looks like a green light, you think you're good to go.
Yeah.
Only to find out at the 11th hour, when funding is supposed to flow, that the actual surety provider hadn't formally committed yet.
And the whole multi-million-dollar project, like the Ascent, just grinds to a halt?
Precisely. Because the funding won't be released. So the information in those letters, the stated bond limits, how long the contractor has had a relationship with that bonding company, is all absolutely critical.
It helps figure out if the contractor can actually deliver the goods bond-wise.
Yeah, any misstep there can stop a project dead in its tracks.
Okay, so shifting to the subtrades then. The plumber, the electrician, who maybe never needed a bond like this before, now they have to get one for an MLI Select job. What are their biggest hurdles? This sounds like a whole new world.
It really is for many of them. They often need to establish a bond facility completely from scratch.
It sounds complicated.
It's a complex financial undertaking, yeah. It involves a deep dive into their company's financial statements, their past project history, their operational capacity, their management team.
Wow.
So knowing about this requirement early, way ahead of time, is paramount.
Because if they wait until the last minute,
It can lead to significant delays in getting approved, if they get approved at all. Or even worse, they could just lose out on major project opportunities entirely.
because they simply can't meet these new financial assurance standards quickly enough.
Exactly. It's forcing a complete overhaul in how many sub-trades need to approach their business development and bidding processes, especially for these larger rental projects.
So, okay, what's the bottom line here? For the developers, for the contractors, for anyone hoping to get these important housing projects off the ground, it sounds like the cost of getting this wrong is just massive.
Oh, absolutely. Especially, like you said, when you're talking about projects where millions might already be invested. Think back to the Ascent.
Yeah.
It really underscores the critical need for proactive financial planning and getting expert advice early on in large-scale development.
Because the consequences are severe.
Extremely. Failing to meet these bonding requirements, it means withheld funding from CMHC. It means potentially losing contracts you thought you had. And ultimately, it means projects getting completely stalled.
Imagine pouring concrete, signing deals.
Millions already spent, yeah.
Yeah.
Only for it all to grind to a halt because of a financial requirement that wasn't properly nailed down beforehand. And those risks, they sit squarely with the developer.
Which makes addressing bonding super early in the project timeline absolutely essential now. So it's definitely not just a matter of checking a box on a form, is it? It's not just more paperwork.
Absolutely not. Meeting these requirements goes way beyond just filling out forms. Success hinges entirely on how the developer's financial position is presented.
Okay.
The quality, the type of security they can offer, like that collateral on other properties we talked about.
Right.
And just the overall thoroughness of all the supporting documentation they provide to the surety company.
So being proactive helps. Leveraging other assets can make a difference.
It really can. And the earlier these conversations happen, especially with a surety expert who knows this space, the more options tend to be available.
Yeah.
The smoother the whole process is likely to be.
Okay. So let's sum this up a bit. MLI Select, it's still this potentially powerful tool, right, for delivering the kind of rental housing Canada needs. Affordable, accessible.
Definitely. It remains a key program.
But the message seems crystal clear. This bonding requirement has unequivocally raised the bar.
It truly has. There's no question. Developers, and now sub-trades too, they must integrate bonding into their project planning right from the very beginning.
Not an afterthought.
Not an afterthought, not a last-minute scramble. It needs to be treated as a core part of their overall financing strategy, period.
And talking to an expert early seems key.
Early engagement with a surety expert, someone who deeply understands the nuances of MLI Select and CMHC's expectations, that can help navigate this whole complex process much more efficiently.
Avoid those costly 11th hour surprises.
Exactly. And crucially, protect the project timelines. So whether you're a self-performing developer or you're hiring a GC or you're a sub-trade now being asked for these bonds for the first time.
The messages.
Factor bonding in from day one. It's non-negotiable now to these projects.
So wrapping this up, what does this all mean for you listening, whether you're, looking for a home yourself or maybe just curious about how our cities actually get built? It means that even these really complex, sort of behind the scenes financial rules, they can have a very direct line to our everyday lives, to the places we call home.
Yeah.
The availability, the affordability of housing, it's directly impacted by regulations like these CMHC bonding rules.
It's a really powerful testament, I think, to how interconnected our financial systems are with our tangible realities.
Yeah.
How a seemingly small change, a tightening of one rule, can have a ripple effect that genuinely touches everyone.
Yeah.
And this whole situation, it raises a really important question looking forward. As Canada keeps navigating its long-term housing needs, how do these types of, nuanced regulatory adjustments actually interact with the broader market dynamics?
What does it imply for future housing policy?
Exactly. And maybe even more broadly, what other invisible rules or shifting requirements might be out there, quietly shaping the availability and affordability of homes? And what role do we, maybe as informed citizens, play in understanding these hidden levers? It's definitely a conversation that extends far beyond the boardroom or some technical finance office.
It really demands our attention, doesn't it? Because these details, however small they seem, can genuinely shape the fabric of our communities.
Absolutely. Food for thought.